We got a lot of questions. We've done a lot of zero DTE. We've done a ton of zero studies. We've done none with long buying strangles, buying straddles, buying strangles, buying calls, buying puts. We've got a ton of emails saying, hey, show me the other side. Do you think you make or lose money by buying premium in
long 0 day?
Yes.
Obviously, if they go out to our area, I'm going to say no. It's going to be hard, or the drawdown would be too large to sustain it to become profitable. If they go closer and they manage you've watched these, you've traded them. They move quickly. There are times to manage these for small $50 winners where maybe buying premium, if you're nimble, could be okay in the 0 days if you're close to the money.
Surprising results are going to show that allergies. Surprising results are going to show.
I haven't seen this, so I don't know.
That if you're very nimble, yes, you can make money.
Oh, okay, cool. Gesundheit. Everybody's replaceable, Tom.
Everybody is replaceable.
Everybody is replaceable.
Zero DT marketplace in liquid underlyings has been one of the most profitable arenas for retail traders in recent times. At Tasty, our preference for high probability trades leads us to mostly taking short premium positions. In a two-sided efficient market, traders should be able to profit by using either short or long options. If aggressive management has been the key for success in selling zero DT premium, what kind of approach has been most successful for purchasers?
Now, I'm going to put a little bit of, I don't know where they're going with this, but I want to say it beforehand. And Thank you for the CBOE for sponsoring all this. If we're using mid-price, intraday, let's just say, there are times when you can't get filled at mid-price. So some of these results, I would skew them down a little bit just because you're going to have to give up a nickel to get filled on a lot.
We always say, go to the next slide. So, as you can see, the last bullet point here is all trades were assumed to exercise at mid-price. Because long options are inherently defined risks, no additional buying power reduction controlling options is required. So you don't have to buy the wings, but they're specific in here to make sure you understand that you're probably going to give up a nickel off mid-price.
Sure. Very good.
Okay, same thing, 18 months worth of data. We can purchase zero DT strangles at the market open using the 20 and 30 deltas. We contrasted the performance of closing the winning trades if their profits exceeded a certain percentage, or closing the losing trades if their losses crossed given percentages of their max potential loss. So we're trying to control losses here, do everything we can. Let's go to the next slide. Something here. Fix this.
Really?
Okay. So the first thing is buying 30 delta strangles. That's buying the put and buying the call. What's interesting here is that if you close them quickly for a profit of 10%, now how much is a 30 delta call or put? I'm going to guess it's probably going to be around, I'm going to guess probably 12.
Premium you're talking about?
Yeah.
0 day?
Yeah.
30 delta?
Yeah.
You're looking at right now, around 5. 6.
Right now about 5, but what is it what do you think what is on the opening? About 7 or 8? Maybe 9? That's hard for me to say.
Well, you know what? I'll go 1 day just to maybe we can extrapolate out. And it's about $11, $12 on each.
Right.
I'm going to go 8 or 9.
Okay, 8 or 9. Mm-hmm. So 10% would be 80 cents, 77% chance. Close at 25% profit, 67% chance. 50% profit, $1. So the daily P&L for managing your winners was pretty positive on buying 30 delta strangles. Everything on this slide is good. I like the 67, 58% chance, making a little money. Okay, cool with that. Let's go next slide. That's managing your winners. That doesn't mean you can't be short the same thing and still make money either.
Yep.
Okay, so this is if you try to manage your losers. Now, this means make adjustments to everything else. And this is where you get into trouble. It's really hard to manage your losers. When you're trading short premium, it's easy to manage your losers. When you're trading long premium, it's really hard to manage losers.
Yeah.
So We've
always said this. This is almost like your hedge.
Yeah.
When do you get out of your hedge?
Exactly. So if you're managing your long premium trades at a certain percentage of whatever you paid for it, that works. But if you're trying to manage it and adjust for losers, that does not work.
Yeah.
Look at these win percentages, really bad. Let's go to the next slide. So we went to the 20 delta strangles, a little further out of the money, and you still made money across the board. You didn't make as much money And to be fair, if you're going to buy the strangle, you're better off buying the 30 delta strangle than the 20 delta, because you basically have higher percentages across the board and you make more money. So you're better off buying the 20 delta strangle. If you go to the next slide, Beth, it's the losses for 20 delta strangle. Yeah, and you can see here, if you tried to manage your losses, really rough. 5% win percentage, 7%, 14%. This is dark.
This is dark.
Well, it is. You can't manage the losses. It's really hard. So that's the takeaway here. Managing winners, possible. Managing losers, impossible. From a long premium side. Let's go to the next slide. So over the past 18 months, zero DT traders could make money on either shorting or longing strangles at the market open. The key was using the right management mechanics. I think we're the only group that's ever researched this at this kind of detail. For long zero TT strangles, managing losers was generally counterproductive. Long options are inherently downside limited already, right? So managing winners was effective, but long premium traders still need to be patient and willing to accept a lower percentage of winning trades than short premium trades. If you remember, short premium was like 90+%. Yep. Long was 70%. But short premium traders, in order for their wins to be big enough to outweigh the losers. And so anyway, it's an interesting study because it shows that either side is, if you have the right management mechanics, right management techniques, should be.
There's no set it and forget it in the 0-day world.
Nope.
That's really what it comes down to. Nope. We usually live in a 45-day time frame, and we always talk about managing at 21 days before expiration. You don't have that time to be.
I would have taken this to another level, and I would have done it based on the VIX 1 day, because the only reason I sold premium yesterday and it worked was because the VIX 1 day was at 15. Today, the VIX 1 day.
Just going to look because you mentioned it.
Today, the VIX 1 day is at 975, down 427. I wouldn't touch it with your money.
Good work. Good work out of you. Good job. Nice real study here for people who trade those 0 days. We're going to take a quick 90-second break and come back with more Tasty Live after this. Start off with your friend and mine, Mr. Scott Sharon, Tasty Trade World Headquarters, the #1 brokerage firm in the galaxy. We'll be back in 90 seconds. Tasty Live.